Good morning. It's Wednesday, the 14th of August, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. Today's take, borrowing to invest. Financial journalist Tamal Bandyopadhyay, in an insightful column in January this year, recounted how he asked a group of youngsters in a bar in Kolkata how they could afford to pay for the somewhat pricey drinks. The answer was first, that none of them had jobs. And second, they were borrowing money on loan apps, as low as 1,500 rupees or 1,500 rupees. They apparently usually repaid the loans with earnings from tuitions or giveaways from their parents. And they repaid it quickly and thus kept their credit scores high. A host of crackdowns by the Reserve Bank of India across the financial sector this year has revealed borrowings at all levels. The big one, under which the previous example comes under, is what is known as unsecured loans or small loans for which there is no collateral. And that includes, by the way, credit cards, all of which have been rising. And then in March, the Reserve Bank of India asked IIFL, a financial company, to stop sanctioning or dispersing new gold loans because it had concerns on the company's gold loan portfolio. More specifically, in the quality of gold that was deposited with IIFL to take those gold loans. So which is quite shocking actually, because it means that people were depositing substandard gold to take loans. It also means that the gold was not being checked properly by the lender or overlooked. Now, there are many more examples of small loans taken by individuals. It could be for mobile phones. It could be for loans as in cash. It could be what is known as buy now, pay later, and so on and so forth. Granted, the reasons for these loans could be several, but it does appear that investing in the markets in general, or in some or many cases, dangerous derivatives products like futures and options could be another reason too. India, by the way, has the world's largest derivatives market. And Bloomberg says India's futures and options turnover hit a record $6 trillion in February from less than $150 billion 5 years ago. A large part of this growth followed the introduction of weekly expiring contracts in 2019, which replaced the traditional month-end expiries. The Reserve Bank of India, by the way, is on record to express concern in general terms about savings going into areas like this, which is derivatives, an area where 9 out of 10 traders, as per official data, lose or lost money. And it is my experience that Reserve Bank of India's general comments usually have very specific data behind them. The Wall Street Journal carried an article yesterday saying investors borrowed like crazy during the rally and now they're paying the price. And we're talking about global stock markets. Now, the headline might make you feel that these are like-minded young folks sitting in the United States or other countries as well. Well, yes and no. The article actually speaks of large institutional investors and how the market meltdown in recent weeks has been driven by the rapid unwinding of several popular trades and the heavy use of leverage or borrowing. Translated, whether it was these boys in the Kolkata bar or the smart and savvy suited booted Wall Street investors, they were doing roughly the same thing. Of course, the interest rates vary. Investors were borrowing in Japanese yen at close to 0% interest and investing elsewhere in stocks and bonds, and got shocked out of their wits when the Bank of Japan raised interest rates to 0.25% and ran for the door to start selling. This, of course, triggered a shockwave last week that enveloped Indian markets as well. Now, in the case of the small borrowers, the ones we've been talking about, the rates could be anywhere between 30 and, hold your breath, 60% an annum. Elsewhere, India's credit deposit ratio is a concern, which means that deposits into savings accounts are not growing as fast as banks are giving out loans. A healthy gap between the two should be there, but it isn't, and the Reserve Bank of India once again has been consistently referring to this, including just last week. So the Reserve Bank of India is now exhorting banks to step up deposit mobilization, which of course will only work up to a point. Savings are coming down because people are buying homes, and that's a good thing, but also putting money into stock markets through mutual funds, if not directly. And a key reason for all of this is that incomes are clearly not growing enough to keep pace with aspirations, or at least in many cases. And of course, in many cases, there may be no incomes at all. And where there are incomes, even if growing steadily, inflation is eating them away at an unprecedented pace. Now, that is where things are. But the solution to high inflation and low incomes and high aspirations cannot be borrowing to invest. Borrowing to invest is a dangerous phenomenon for any investor, large and small, as we are seeing. And usually it ends badly, or only the smartest are able to get out in time. Most will not. And that brings us to our top stories and themes for the day. The markets fall on weak signals. The share of thermal power production in the overall power mix has fallen for the first time in India. The Red Sea crisis leads to a 64% jump in global cargo ships calling and fueling in India. Fitch Ratings says lower attrition, slow wage growth is helping Indian IT companies maintain profitability.
This is the Core Report with Govindraj Ethiraj.
Markets and more. So Indian stocks lost traction on Tuesday, led by HDFC Bank's decline on a lower than expected inflow thanks to a staggered weight adjustment on the MSCI index, Reuters reported, and I'll explain that shortly. The NSE Nifty index fell about 208 points to close at 24,139, while the S&P BSE Sensex fell about 692 points to close at 78,956. In both cases, the fall was about 0.8%. HDFC Bank fell 3.4% and led the indices down. MSCI said the changes will come into effect, that is, the changes in increased weightage for HDFC, but in two stages, that's in August and November, contrary to market expectations of one move in this month. So the earlier expectation was that about $3 to $4 billion would flow into HDFC Bank after the revision, but the estimate is now $1.8 billion, Reuters reported a brokerage saying. So MSCI. India's weight in the MSCI Emerging Market Index has moved from about 8% in 2020 to about 20% today and could cross 22% by the year end, according to analysts quoted by Business Standard. And we've pointed out earlier, the share of China in the same index is down. And the share of a country or stocks within that obviously reflects the kind of money foreign portfolio investors put into stocks, in this case being HDFC. Elsewhere, consumer products company Marico gained about 2% after restarting its manufacturing operations in Bangladesh, a larger sign that business operations in that country, in which many Indian companies have a presence, are restarting in the light of the recent political turmoil. And speaking about turmoil, global markets and notably Japan, where the meltdown began last week, is almost back to normal. Reuters called it Wall Street's rapid healing on Friday and said how Japanese stocks completed their week-long hair-raising round trip on Tuesday as Tokyo markets returned from holiday and then wiped out the remainder of last week's losses. So bottom line is, life is returning to normal quite quickly after the meltdown last week, triggered in turn by the yen carry-forward trades. On the other hand, of course, some reports are saying it is still early to give the all-clear to the rapid unraveling of these carry trades, warning investors that the unwind may still have some room to run. CNBC quoted a TD Securities analyst saying that he'd be very hesitant to declare the end of the carry trade unwind, despite suggestions from some economists that the rollback may be largely complete. Action in oil. First, the prices. Brent crude futures are now above $80 for the last few days. That's a barrel, quoting at about $81.8 a barrel, or just under $82 a barrel, having jumped on Monday. Lots of developments on oil in general, also reflecting, among other things, the varying conditions of the global economy. Top oil refiners in the United States are throttling back operations at their facilities this quarter, adding to concerns that a global glut of crude is forming, according to Bloomberg. Marathon Petroleum Corporation, owner of the largest refinery in the United States, will apparently operate 13 plants at an average of 90% of capacity this quarter, the lowest for the period since 2020, which, as you know, is the COVID period. Similarly, PBF Energy said that it was preparing to process the least crude in 3 years, while Phillips 66 will run its refineries near a 2-year low, and Valero Energy Corporation expects to also trim oil processing, according to Bloomberg, which added that these 4 refiners account for about 40% of America's capacity to churn out gasoline and diesel. Now, if demand in America comes down and if there's no counterbalancing reduction in production, then you can expect oil prices to also go down. And here's the other interesting oil news. Indian ports reported a 64% year-on-year increase in the total number of bunkering and ship-to-ship calls during the first 7 months of 2024, according to S&P Global Commodity Insights reported by Business Standard. Bunkering, if you didn't know, refers to the process of supplying fuel to ships. So the new fuel supply route follows attacks on ships in the Red Sea region, something that we've been referring to. S&P says the Red Sea crisis has prompted ship owners to choose longer routes around Africa, resulting in a substantial increase in monsoon bunker demand at Indian ports. The crisis began in October 2023, which also ties in with the date Hamas attacked Israel, and this has obviously managed to persist since then. The total number of bunkering and ship-to-shore calls to Indian ports was more than 6,765 compared to about 4,113 during the same period in 2023. Interestingly, this figure usually slows down due to weather disruptions at this time, being monsoons. However, it did not happen because of favorable pricing and consistent supply from domestic refineries since the second quarter of 2024, says S&P Global. According to that data, Mumbai was one of the major bunkering hubs in the country, which saw a 53% rise in total bunkering and STS calls. The report also said that market participants stated that the monsoon has had little effect in Mumbai this time on these calls. Fitch projects a modest rise in IT services profits. Indian IT services companies could only see a modest rise in their profitability as their clients will continue to hold off a discretionary IT spending amidst economic uncertainties, according to a latest Fitch Ratings report quoted by Business Standard. However, the clients will continue to spend on projects that focus on cost efficiencies, the report said, adding that Fitch's global economic outlook projects US real GDP growth to slow to 2.1% and Eurozone real GDP to pick up to 0.8% from 0.5% earlier. Now, Fitch says that this economic backdrop will support revenue growth in the mid to high single digits on a constant currency basis, that's in dollars, for most Indian IT services companies in 24-25, which is in line with their performance last year as well. Fitch also said that the IT services long-term growth will be supported by client spending on digital transformation, cloud migration, and artificial intelligence. Interestingly, and this is the part that's worth noting, it points out that Indian IT services companies have benefited from declining staff attrition rates in 23-24, that's the last year, which has also reduced wage pressure. Or put differently, people are not quitting jobs often and sticking on despite modest pay increases, if at all. Staff attrition for most Indian IT services companies peaked in 22 at about 22% when the shortage of skilled IT staff led to increased competition for talent and obviously high wages, according to Fitch. Now, this is good news for the companies who are evidently breaking free of the stranglehold of job-hopping engineers. Fitch says that lower wage pressures and increase in utilization rates and employing a higher proportion of fresh graduates will benefit profitability. So that's the silver lining at the end of it all. Thermal power generation contribution to the total power mix is falling for the first time. So, a big jump in renewable energy capacity, for example, solar power, is reducing the share of coal-based thermal power plants by over 500 basis points to 67% in the coming year, after rising continuously in the last 5 years, according to a new report from rating agency CRISIL. We'll unpack all those numbers in a moment. The share of thermal power in overall power generation had increased to about 73% last year from about 69% in 2020. Now, this is obviously because of the growth in demand in the last 4 years being largely met by thermal generation or coal-based power generation. So, renewable energy and other sources like nuclear, hydropower, and biomass were only growing at about 3% compounded annual growth during this period. Now, all of this is now shifting and changing. Incremental renewable energy generation growth at 20% will be higher than the overall power demand growth of 5 to 6% over 25 and 26, that's 2025 and 26. The macro reason is obviously the strong policy push and capacity addition of more than 50 gigawatts projected in the next 2 years by 2026. Now, thermal power that's coal-based is of course critical and necessary because renewable energy in the form of solar runs during the day and cannot be depended on to provide what is known as base load power or the steady power that will come what may. I reached out to Manish Gupta, Senior Director and Deputy Chief Ratings Officer at CRISIL Ratings, and I began by asking him whether this was the first time we were seeing a decline in thermal power generation in the overall power mix and what that meant.
So your question, I think, is it happening for the first time? Yes, the answer is yes. Essentially, what happened was in power sector, let me just begin by giving you a perspective. Like in power sector, there are three types of major capacities. Like firstly, the thermal capacities, where dominantly coal is the major fuel that is used. So out of the total capacity in India, somewhere close to 435 gigawatt, around 243 gigawatt is thermal. And predominantly 80-90% of this will be coal-based capacities. Renewable energy, which is solar and wind, they form the second chunk, which is around 120 plus gigawatt at the moment. And thirdly will be all other sources, which include hydro, your nuclear and other biomass, etc. So which will be around 70 odd gigawatt. So what was happening so far was that given the pace of growth in demand, that was their demand for power, bulk of this incremental demand was being met through thermal generation only. While not much of a thermal capacity add was happening, but thermal PLFs, which is the unit for measuring the utilization level of thermal plants, that was rising. Part of this incremental demand was also being taken care by renewables. But for the first time now, we are seeing that renewables is taking the lead in meeting the incremental demand. And that is a big shift that we are really talking about as part of our study.
Right. And this, I'm assuming, is mostly daytime.
No, so when we talk about the power demand, that's power demand for a full day basis, not about the peak demand that we are talking about. So it's about total power consumption that we are seeing.
So there was a lot of power generation capacity that was also projected in terms of fresh capacity and so on. So where are we in that broad sense in terms of total projected, how much renewable has pitched in and how much it could pitch in coming years?
Yeah, so see, renewables has been the forefront in terms of the new capacity add in the power sector. So as I said, I think they have already reached a level of 120 odd gigawatt. Previous year, we added somewhere close to 19 gigawatt of renewable energy capacity in India, which includes both solar and wind. This year, we are going to see a step up from 19 to around 25, 26 gigawatt, and something similar we are expecting for the next year as well. So this is one of the major reasons why we are seeing that, renewable energy capacity is going to lead in terms of meeting the incremental power demand, which may eventually result in reduction in the share of thermal in the overall power generation.
So then would it be correct to say that overall, let's say fossil fuel investments for power generation or energy is going to now start coming down in India at least?
See, this is not the first time that is happening. I mean, if I look at the fossil fuel power generation in India over last 4 years to fiscal 24, overall, somewhere close to 12.5 gigawatt of capacity had come in last 4 years. What we are seeing now is a slight tapering from there. So if 12.5 has come in last 4 years, we are going to see 10 gigawatt coming in the next 2 years. So while we are seeing thermal was any which way slow, some bit of an uptick that has happened as of now, but the pace of growth in renewable is far higher, because of which we are seeing renewable taking the lead in the overall power generation mix.
Right. And what's the capacity versus utilization in thermal and how is that looking for the next couple of years?
If I look at firstly the thermal utilization level, as I said, I think utilization in power sector is measured from plant load factors, or which is commonly termed as PLF. We have been seeing some bit of an uptick in the PLFs of thermal power plants, which has reached to a level of somewhere close to 69% as on fiscal 24. From here on, we are expecting that there could be some bit of a tapering, but it will still remain upwards of 65% in the foreseeable future. While this is the level for thermal, but in renewables, the PLF levels are much lower. They are at around 19-20%. So while in gigawatt terms, we are seeing a huge capacity add, but the proportion of renewable energy in the generation mix, that still remains at around 12-13% as we talk. As we go forward, we are seeing this proportion of renewable energy mix increasing because of increased capacity add over here.
Are there any trends that you're seeing in these numbers that are also allowing you to project or giving you an insight about how investments are going and how also, more importantly, consumption is happening at this point of time or are likely to happen of energy?
Okay, let me just first talk about the consumption. I think consumption has been pretty strong in the previous years as well, something to the tune of 6-7%. And our expectation is somewhere close to 5.5 to 6% will continue over the medium term. In terms of investments, while private sector has been very, very active in terms of adding new capacities in the renewable energy side, on the thermal power side, it has been very tepid and very limited capacities from private sector has come in. Most of the capacity out of the 10 gigawatt that I was talking of is likely to come in from central sector PSUs and some state PSUs as well. So that's the trend we are seeing in terms of investment in the power sector from a generation point of view.
So you're saying private sector participation in thermal power or fossil fuel based energy is reducing much more than public sector?
In the thermal side, yes. Actually, it has reduced quite a lot in the past itself. And today also it remains at a low level. And most of the investment in the thermal side is going to be coming from the public sector companies or the government linked companies.
Right. Manish, thank you so much for joining me.
Sure. Thanks a lot.
Indian origin CEO of Starbucks is out. Starbucks has somewhat abruptly parted ways with Indian origin CEO Lakshman Narasimhan, who came to it via Pepsi and Reckitt Benckiser, where he was CEO earlier, and has now appointed current Chipotle Mexican grill chief Brian Nicole as its next CEO. which is an abrupt change for the coffee chain as it works to turn around its business and contend with activist investors, says the Wall Street Journal. The Seattle-based company said on Tuesday that Nicole will start as CEO and executive chairman of its board on the 9th of September, and Lakshman Narasimhan will step down immediately. Nicole will be the sixth person to serve as Starbucks CEO in the company's history and the second to come in from outside the company. Narasimhan, who joined in March 2023, was the first. Starbucks operates close to 400 stores in India and came to India in 2012 and has said it's targeting 1,000 stores by 2028. The Wall Street Journal said Starbucks has spent weeks negotiating with activist investors on ways it can address slowing sales and operating problems. And last week, the Wall Street Journal also reported that another activist had taken a stake in Starbucks. And before I go, Thursday, August 15th is a holiday and the market's holiday as well. So we will not be having an edition. We should be back on Friday, August 16th. And that's the day we are also hosting a small virtual meet with our newsletter subscribers and listeners of this podcast, for which you are duly invited. The links are below. We want to hear from you and also use your feedback to develop our editorial content and approach going forward. So the date is Friday, August the 16th, and the time is 5 p.m. Indian Standard Time, and we'll be meeting on Zoom. Once again, the registration link is in the show notes. Look forward to seeing you there. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.